Okay, so good morning and afternoon, everybody. Welcome to another webinar of our Opus Connect webinar series. Definitely excited to have you all with us today. We have an educational webinar today on insurance strategies for your portfolio companies to consider during this time. So looking forward to getting into that. But before we do, we have a few housekeeping things that I want to get to. For those of you who are not familiar with who I am, my name is Lena Dobrier, and I am the Director of Operations at Opus Connect. We are a lower middle and middle market focused M&A organization. We are membership based. We have chapters in Los Angeles, New York, and Chicago. In each chapter, we do monthly seminars, currently doing them virtually. And in addition to those monthly seminars, we do deal sourcing events all around the country. So I think we're in 15, 16 different markets now. We're also in Canada as well. So if you're interested in learning just a little bit more about Opus Connect, feel free to reach out to my colleague, Jacob Zeffrin. His information is here at the bottom, and he'll be happy to answer any questions that you might have. Moving along, today we are going to have an option for Q&A at the end. We'll leave about 10 or 15 minutes, so we definitely encourage you all to participate. As questions come to mind, there is a little chat window at the bottom, sorry, a Q&A window at the bottom here where you can pose your questions, and our moderator will filter through those, and our panelists will get to those at the end. So definitely submit your questions as they come to mind. These events would not be possible without the support of our sponsors, so we definitely want to give each of them an opportunity to say a few words. And I'm not sure if we have anyone from Baker Tilly in the audience, but if we do, please raise your hand quickly. There's also an option to do that at the bottom of your screen, and I will navigate to you and unmute you. But I'm not sure anybody is in the room from Baker Tilly, so I just want to acknowledge them. They're our CPA sponsor in New York. Been a long time supporter, so we thank them for that. Moving on, Ice Miller. Typically, we would be meeting in their law firm right now, but since most of us are sheltering in place, we are doing this virtually, and I do see Chase on, so I'm going to unmute you, Chase, and allow you to say a few words, introduce yourself and the firm. Chase, are you there?
I'm there, Lena. Thank you.
Great.
Appreciate the opportunity. This is our first virtual hosting opportunity. So thanks everybody for coming. You know, I want to thank Opus for doing this and putting this on. It sounds like a great program. Most of you in attendance hopefully are familiar with the firm, but we are a full service law firm with over 300 lawyers. My practice is in the M&A group, and we've got a M&A leverage finance practice here in New York. We also have an insurance practice, so if people have questions about our insurance capabilities, happy to discuss that. And also our busiest group right now is our restructuring group. So in these times, you're having different needs from different clients. So if anyone wants to talk to me after this session or shoot me an email to discuss corporate financing, restructuring, or insurance needs, happy to do so.
Awesome. Thank you, Chase. And then we'll move on to our next sponsor, which is NFP. They've also been a longtime insurance sponsor, and of course they are speaking today. So I'm gonna let our moderator, John McNally, introduce them once we get to him. But before we do that, we do have a few audience poll questions that we wanna get to. So as we navigate to the next slide, we have 5 questions we wanna ask. We do encourage your participation. You will see the first one pop up on your screen momentarily. So we'll give you a few seconds and let you enter your choice, and then we'll move to the next, and we'll try to do this fairly quickly so we can get to the good stuff. So we want to know, how did you hear about today's event? Through Opus Connect, one of our speakers, sponsors, LinkedIn, other. It's helpful for us to know where you're all coming from. So appreciate you contributing here. We'll give it about 5 or 10 more seconds, and then we'll move on to the next one. Looks good. Thank you to our sponsors for helping us promote the event. We definitely appreciate that. Let's move on to the next question here. We have a couple questions as it relates to today's conversation. So has your company, if you're an operating partner or a company in which you're an investor in, alter 2020 revenue forecasts. We have a couple options there. Okay, so it looks like most of you are expecting a decrease against budget. I don't think there's much of a shock there. Some of you no change, which is great. Okay. We'll give it maybe 5 more seconds and then we'll move on, but that's helpful for us and for our panelists to understand as we move through today's discussion. So let's, yeah, 90% of you. Okay, great. Let's move on to the next question here quickly. Has your company, has your company or company in which you're an investor made a claim related to COVID-19 under any of the following insurance policies? Okay, workers' comp, property. No one from general liability yet. No directors or officers or employment practices liability. Okay. Give it about 5 or 10 more seconds and then we'll move on to the next one here. Great. Okay, so majority property. Got it, good to know. The next question here is, have you had to lay off anyone, reduce compensation? Have you furloughed? We're trying to figure out which percentage of you all have done any of the above. Okay, 50-50. Give it about 5 more seconds here and then we'll go to our last one. Great. 50-50, interesting, okay. Our last question here is, have you utilized government stimulus funding? Yes or no? Cool. Okay. So we appreciate you guys contributing to these questions. Again, this is really helpful for not only us, but our panelists to understand as they move through the conversation today. So thank you for that. Without further ado, I'm going to introduce our moderator, John McNally of NFP. He's going to be our moderator. We appreciate you jumping on to share the knowledge, and I'll kick it over to you and kind of bow out here and let you take it from here.
Okay, thank you, Lena. And again, thanks everyone for taking time to join us today. I think in terms of NFP, our introduction, NFP provides employee benefits, individual solutions, and property and casualty insurance advice to companies, including private equity funds and their portfolio companies across the US and Canada, as well as in the UK. And, you know, I think that we have a lot to cover, and so I don't want to spend too much time leading into this, but what I think, just to put it in context, thinking about the insurance industry, and we're going to focus this seminar on private equity and really what private equity funds and their portfolio companies should be looking to in terms of employee benefits and you know, particularly property and casualty insurance programs. And a lot of you checked property insurance, so we're going to start with that in a second. But the context, I think, is thinking about how much uncertainty is there over the amount of losses that we're going to see from the coronavirus and COVID-19. So Evan Greenberg, who's the CEO of Chubb Insurance Company, said earlier this week that coronavirus will likely spur the largest single loss in insurance industry history, which is bad, right? It's pretty bad, you know, and that shows the uncertainty that a lot of commercial insurers have around how great those losses are going to be. Yesterday, David Long, who's the CEO of Liberty Mutual Insurance Company, said the impact of COVID-19 will be like a moderately sized catastrophe loss, so like a reasonably bad hurricane. And, you know, the question is, you know, who's right? You know, nobody knows. Nobody in the insurance industry really knows. You know, we've seen insurers start to take reserves starting with Q1 over what the impact's going to be, and they all, as we all do, expect Q2 and Q3 to be worse. I think the point is, the reason insurance companies can't agree how bad it's going to be is because, number one, we don't know what the legislative outcomes are going to be. So we're going to be speaking, Sarah and Chase are going to be talking a little bit around that, but also, regardless of legislative impacts, how widely and effectively companies make claims under their commercial insurance policies will have a big impact on what those losses are ultimately. So we're going to spend some time talking about that. And similarly with employee benefits, we don't know how long businesses can hold out without laying off employees, without making people redundant or furloughing employees. So, or when those employees are, in fact, are going to return to work. So we'll also be speaking around how some of those impacts with respect to employee benefits may look. Mostly, we really want to give you practical advice over the next 45 minutes or so on commercial insurance and benefits. Everyone right now is triaging their portfolio companies that aren't performing because of what's going on with COVID-19. And so we know you're busy, but with respect to potential recoveries and how to deal with benefits and insurance issues, we want this to be kind of a broad survey across a bunch of different types of insurance policies and benefits issues. We're not going to go into a deep dive at any one point, but we're happy obviously to follow up later on, with respect to anything we cover today. And lastly, we realize that different types of companies, and you have portfolio companies that run the gamut across the spectrum, everything from really impacted businesses in hospitality and leisure and travel and retail, and and there are going to be business interruption issues there for sure. Other things like the food industry and some industrial businesses that it's really going to be workers' comp and casualty issues. So again, we want to try to cover all of these different areas and give you some thoughts, our best thinking around how those impacts may work with respect to these different types of policies. So with that, I want to hand over initially to Sarah Sherman to talk about property. So Sarah, over to you.
Hi, thanks, John. I'm a property specialist at NFP and a managing director, and I sit in Boston. Next slide. So today we're going to talk about how a property policy may or may not respond to a COVID-19 loss. Currently, we're seeing COVID-19 property losses fall into really three categories. Loss of revenue due to property closure by a government agency or self-directed. Loss of revenue due to reduced customer activity, and then contaminated property. I can't stress this enough. If you suffered a COVID-19 loss, it's critical to consult your own policy. We've had a lot of clients saying, hey, should I submit a claim? I was talking to another CFO who said they were doing it and they've got cover, so I think I'm going to submit it. It really comes down to the specifics of your own policy and the wording outlined there, as well as the own nuances to your individual claim. So you could have two policies that have the same wording, but very different claim scenario and very different claims outcomes. So we really urge you to review your own policy wording. So before we get into how these policies may or may not respond to COVID-19, it's important to understand how a property policy works. Typically, coverage has got to be triggered by physical loss or damage to insured property. The keywords there are trigger and insured property, right? So the standard view here is infectious disease like COVID-19 does not constitute physical loss or damage. And therefore it cannot be considered a coverage trigger. Furthermore, lots of policies also include exclusionary language around infectious disease. So they take it one step further rather than just relying on the connection between a policy being triggered by physical loss or damage, but they go on to say that all infectious disease, virus, et cetera, is not considered a covered peril generally. We're going to talk about some legislative change potentially there, but I wanted to walk you through that first. So we've had a lot of questions about civil or military authority. This extension covers the loss of revenue due to restricted access or closure of your property by the government. However, this coverage, again, has got to be triggered by physical loss or damage. So a good example of this is there's a local business that's closed by the government due to a wildfire nearby. In this case, the fire and the damage that the fire is causing in the neighborhood, therefore the physical loss or damage, that is the trigger, right? So in the case of COVID-19, if we rely on the traditional or standard coverage view, COVID-19 would not constitute physical loss or damage to trigger this sort of coverage like civil or military authority. Now there are exceptions. In very rare cases, insurers have agreed to provide limited coverage for infectious disease, but they're subject to a variety of restrictions. And again, this is why I say it's so important to review your own policy. So in these cases, we consider them carve-backs. They're very few and far between, and they become even more rare in the past few years as the property market has began to really firm, kind of beginning of 2019. So it's much more difficult to get this coverage, and now with the presence of COVID-19, we've had a lot of questions of, hey, can I go get that cover now? Or at my renewal, can I add it? Obviously, we're in the middle of a pandemic. No, we cannot. And I think in the future, there may be some products that come out of it. But again, very restrictive, very expensive, and likely not part of a property policy per se. It would be a standalone product. So I think, let me just come back here. So we've got this is kind of the life cycle of a property claim. So you've got the claim that comes in, you review your terms and conditions, you think about submitting a claim, you do submit one, your carrier reviews it, and then they give you your answer, right? And we've had so many clients that really want to go on record with a coverage position, whether it be positive or negative, and then so they can take it to the next step. And the next step really is the market's coming back and saying, hey, we agree there potentially may be coverage and we're going to start the process. Or, and especially in this case, 9 times out of 10, they're denying coverage. Now, we haven't seen any property markets come out with a unilateral coverage position to say any COVID-19 losses are not covered. We haven't seen that. This is going to be on a case-by-case basis, but generally the losses that NFP is seeing, they are denying the claims, with the very few exceptions like we just talked about regarding these coverage carve-backs. And in that case, they're not commenting on, yes, it's covered. They're just saying, hey, there may be coverage here. Let's start the proof of loss process. So we've talked a lot about the standard coverage view, which really has been the predominant view for many years around a property policy, that it takes physical loss or damage in order to trigger property coverage. But interestingly, out of COVID-19, we're seeing a big push on this emerging coverage view, both from a legislative standpoint, and certainly we're going to see it from a litigation standpoint. But really 2 primary areas I want to talk to. One, state by state on the legislative, and then also we'll talk about federal. So we are seeing across the states, and I believe right now there's 6 states. If you go on NFP's website into our COVID-19 area, you'll actually see a link where you can click and you can get day-by-day updates on each state's legislation, not just about property, but benefits, et cetera. But it's all done state by state and super helpful as you look at where you're seeing your own losses. But basically, the premise is that traditional exclusions and the requirement of physical loss or damage to trigger a property policy are being challenged by legislators. We don't know where this will end up. We're seeing states push to say you've got to pay no matter what. You know, I think the flip side of that we're going to see too is, do we run into an issue of insurance or insurer insolvency? And that's certainly going to be taken into consideration as these things move forward. But we're tracking it closely. I've highlighted two states here, New York and Massachusetts. Again, they're the 2 of the, obviously New York is the biggest hot zone in the US, and then Boston, I think, is 3rd. So I thought those were pretty appropriate to do. Next slide. So this is the federal update, and just to kind of set the context here about how the federal government gets involved in insurance, we certainly saw this at play after the 9/11 terrorist attacks, where the US government created a backstop for insurers to buy into, and clients were able kind of opting in or opting out. And if they opted in and there was a loss, then you had, markets had the backstop behind them of the federal government. This is where NFP is tracking things very closely. This is I would say a long-term play for this sort of issue. I really hope that we don't have a COVID-19 situation again, but in the event that the government can put together a backstop, this would be a really nice option for clients and markets to be able to have some safety there, because certainly, as I mentioned earlier, we've got to be mindful of carrier solvency. And certainly this would be a mechanism where we could get the cover for clients, which is so desperately needed, but also have a backstop for the insurer so they could remain viable. I would like to turn it over now to Chase. He's going to talk about furloughs and return to work from a benefits perspective.
Excellent. Thank you, Sarah. Hello, everybody. I'm Chase, and I'm an ERISA and a tax attorney. I've been with NFP for about 10 years now, and I head up our national compliance practice, trying to help employers all across the board stay in compliance with the many federal and state rules that are coming up. And obviously, they're just coming so much faster the last few weeks with the situation we're in. So I wanted to start with a discussion, you can go to the next slide, talking about furloughs and return to work. And we'll start with furloughs. And really we're shifting now and talking primarily about medical insurance as an employee benefit, but also other plans right within the benefit offering of any employer, including dental, vision, disability, group term life. And I won't hit very much on retirement. That's not my specialty. But just thinking about things, and a lot of these considerations you may have already gone through as a company because we're now sort of into this over a month now. Some of these decisions with furloughs or layoffs you may have already made. We had that poll at the beginning saying 50% of you have already done something with respect to a furlough or a layoff or a reduction in compensation. And so some of these considerations here you may have already worked through, but it's important to understand those as we get to the next part when we talk about return to work. Some of the decisions that you've made impact return to work. But first of all, I just want to talk a little bit about furlough versus layoff, because this has been very confusing for companies. What's the difference there? And to be clear, there is not like a federal definition of either one of those. But when we say the word furlough, we're usually talking about an extended unpaid leave of absence. The employment relationship remains intact, and the employee is not showing up to work, usually not being paid. Whereas a layoff is more a severance of the employment relationship. That's considered a termination of employment. Now it can be short term, but it's still considered a termination of employment. And so when we start talking about some of these issues with benefits, that distinction matters, particularly with respect to benefit eligibility, continuing benefits through a furlough, and when does the COBRA event occur? When do you have to offer COBRA? Most carriers, and this is sort of the second bullet there, carrier approvals, are okay with extending benefit eligibility through a furlough. But that's a conversation you want to have with your carrier for your medical plan, any other type of plan. Is it okay to continue eligibility? In other words, keep these furloughed employees on the benefit plans through the furlough period. Most carriers are okay with that. If you're a self-insured plan, you want to talk to the stop-loss carrier to make sure they're okay with that. So we're seeing a lot of employers continue eligibility. That, of course, gets to the fifth bullet there, continued eligibility and benefit premium payments. And this is really where we start getting into the talk about cost, savings costs, and figuring out whether you as an employer want to continue paying premiums at the same level as you did before if you continue eligibility, picking up the tab for employees, or shifting the entire cost onto employees to pay while they're out on that unpaid leave of absence. And so some things to consider there relates to premium payment. How are you going to have employees pay those premiums if you're requiring it from them? Usually you do that through paying as you go through the period. So it'd be the same cadence of premium payments from the employees, but you collect it via check, you collect it via PayPal, some other electronic means, a money order. That's okay, that's a common practice to do. Another common practice is to pick up the tab while the employee is out and then collect it in arrears when they come back. That's also allowed. You can collect those salary reductions pre-tax. When the employee returns, you probably want to spread it out over several paychecks to lessen the blow to the employee when they first come back. So that's usually how those premium payments are handled. Some employers are being even more generous and just picking up the tab and saying, you know what, while we're on this furlough, we're going to pay the premiums for you and don't worry about it. We'll just pick up your salary reductions when we come back to work. The other issue to consider there, and this gets to the COBRA discussion, is if you're an employer using a look-back measurement period under the ACA's employer mandate. So that would be a company that had 50 or more full-time employees or equivalents, including control group members. So if we're talking private equity groups, you may have to look at others within the private equity group. But if that employer is using that look-back measurement period where you're using 12 months previously to determine 12 months eligibility going forward, you may have furloughed employees that are still considered full-time employees through the furlough. That means you need to keep offering them coverage, and it also means that their coverage needs to be affordable. So when you start talking about reducing employer contributions, that can be an issue. If you've decided to terminate employment or terminate eligibility during the furlough, that will be a COBRA event. And then you have a decision to make on whether you want to help subsidize the COBRA if an employee elects it. And in that situation, it's really up to you. There's no requirement. Once that employment relationship is severed, you really can do what you want with COBRA. We're seeing a lot of employers pick up the COBRA for a period of time, maybe a short period of time, or at a percentage for an extended period of time. So thinking through that when you're thinking about costs and getting to this idea of funding and employee loyalty, as you start thinking about what employees are thinking here, you know, it matters to them. It may feel more likely to come back and be a extended loyal employee to you if they are, if you're taking care of them with some of these subsidies while they're out. So those are some things to think about with respect to eligibility, COBRA. We did just get some guidance just yesterday that I didn't put in here because we're still digesting it. Talking about delayed notices. And so if anybody on the call is an HR person, you're starting to wonder about COBRA notices, when do they have to go out? And when do employees have to notify you if they have a marriage or a birth of adoption? A lot of those deadlines have now been extended, and that just happened yesterday, so you may start hearing about that. But that plays into the equation when you're trying to administer all of this. A quick note on the funding for continued eligibility. These SBA or paycheck protection loans that are coming through right now, you can use those for anything related to payroll, and that includes payments for insurance premiums. So that is one source of funding that you could rely on if you qualify for those loans. You can take that money and use it towards insurance premiums. Our understanding is that you can use it for any insurance premium. That would include paying claims through a self-insured plan to keep the plan going. And it can be forgivable as well, as long as you meet the other requirements. I am not an expert on the SBA loans, but I know enough, I guess, to be dangerous, but also to be able to say you can use it for those insurance premiums for sure. One other thing is carrier discounts. We've seen this happen to several carriers, particularly dental and vision, coming out and saying that they are going to give a discount for either a month or 2 months, and we've usually seen that at about 25%. So that's something to look forward to, particularly with dental and vision carriers. There are some compliance considerations there if employees have contributed towards the cost of coverage of the plan and the carrier is issuing a rebate. It could be via a premium holiday, a cash rebate, or a discount. Some of that money needs to be shared with employees. So keep that in mind as well. But if we can shift to the next slide and talk a little bit about return to work. This is really more of where the discussion is going now, depending on where you are in the country. States are starting to reopen business. Obviously, it depends on the industry you're in. We're all across the board here. Maybe a little bit longer till we have this discussion formally with some businesses that are delayed in reopening. But just some things to think about as you're going through this conversation as states start to reopen businesses and as you as an employer start to become more comfortable reopening your business. A lot of those questions are more HR related, you know, creating safe workplaces, taking temperatures at work, and creating social distancing at work. I'm not going to get into those. Those are more HR questions. Our friends over at Ice Miller have a wonderful employment practice. I'm sure they could field those questions. But this, we're focusing more on the benefits again. But we talked a little bit about the ACA employer mandate. If these employees are coming back, you have to look at whether they're considered continuing employees or new hires. If their break in absence is 13 weeks or less, less than 13 weeks, then you will have to treat that employee as a continuing employee. That means you don't apply or you cannot apply a new waiting period. You need to offer that employee coverage as soon as possible, no later than the first day of the month after the rehire. If the absence is more than 13 weeks, then you can treat them as a new hire. That means you can apply a new waiting period. So those are some ACA rules to consider. There's a lot more rules surrounding elections and restoration with respect to medical, dental, and vision. Depending on what, again, getting back to the furlough or the layoff, whether that was considered a loss of eligibility. If it wasn't and eligibility continues when the employee returns, they're unlikely to be able to change their elections. Now, there are a few situations that we won't go into, but just thinking about that generally. We're hoping that the IRS or Congress will put out more rules around those election changes. Right now, they're still a little bit fuzzy. A lot of these rules have been relaxed. A lot of the other rules have been relaxed relating to COVID. So we're hoping the IRS or Congress will do the same here. When you're bringing back in rehires and picking and choosing who you're going to be bringing back, a word of caution that you don't base that on health claims or health status or disability or anything else. If you're looking at the costs of your plan and you know maybe who the people are within your organization that are driving costs, do not use that as a basis when rehiring. That could be a discrimination problem under the several different federal laws. So don't do that. For remote workforce, figuring out how you're going to notify employees. A lot of the new legislation at a state and federal level includes telehealth expansion. So making your employees aware of that's another way they can access care. That will help you control costs and also be able to keep employees healthy while they're working remotely. And then thinking about worksite locations, some of these state laws, particularly in New York, New Jersey, California, they base their protections, most of what we've talked about is state protections, on where you work. And so if you have an employee that used to work in New York regularly and now works from home in Connecticut, do they still have protections under New York law? We're still waiting for guidance on that. So we'll have to wait and see. But those are some things to think about upon rehire. We already talked about collecting premiums in arrears. And then just to wrap up, really focusing again on the use of those federal loans for insurance premiums and then employee perception. So with that, I want to keep us on time track-wise. I'm going to turn it back over, or turn it over to Andy. Go ahead, Andy.
Hey, thank you very much, Chase. My name is Andy Harbut, and I'm a Senior Vice President in our M&A practice. And I lead our due diligence for private equity and corporate clients with respect to their mergers and acquisitions activities. So as a practical matter, I help private equity firms navigate P&C insurance and both on the front end, but also during the life cycle of the investment. Next slide, please. So property insurance has definitely been the sort of the headline risk that most folks have been thinking about, and rightfully so, because that's where you've seen the immediate loss of revenue and would think to look for insurance coverage. Casualty insurance just generally is what we describe the lines of coverage that respond to liability claims. And so what I think is kind of interesting is though property has been front and center, I think right now, and actually really Chase touched on this too, many of the types of decisions that managers are making in the businesses today are going to affect what sort of liability claims they might see in the future. So my sort of overarching theme for how we think about casualty coverage is right now, it's really time to be thinking about risk management, because the actions of managers today could potentially result in claims under all the types of policies we'll touch on today. So what I'd like to do is walk through really the 4 lines of coverage where I think we're most likely to see claims activity. Talk a little bit about how those policies might respond. Talk a little bit about strategies to manage the costs associated with those policies and some of the kind of unique nuances. And then just sort of wrap up with a bit about what we expect the insurance marketplace to do in the future as a result of coronavirus. So the first line of coverage, I think we can actually go to the next slide. So the other overarching comment, all the policies, with possible exception of workers' compensation, but every policy is unique. So what Sarah pointed out, what worked for one company might not work for another company with a different type of claim. So we can give some general advice here, but it is important to consult the actual the policies that are specific to your company. So general liability insurance, as a lot of folks might know, is near universally purchased, and it covers typically a business's premises liability or completed operations exposure. So for COVID-19, this means if a business has a person on a customer or client on premises, or if it's a service-related business and you've got, say, technicians going into customer houses or something similar, and there is a spread of coronavirus that's traceable, the business have some exposure there to claims from third parties. I think the answer is potentially. It's something we're being mindful of, and I think going back to the poll, I wouldn't have expected to see too many general liability claims to this point, because there's typically a lag time for these sorts of things. But we would expect there, under most circumstances, there should be coverage. You have to be careful how you phrase that, but generally the sort of standard general liability forms don't have any specific pandemic exclusions. So it's a little bit softer of an answer than what we're finding under property insurance, where the starting point was no, there's no coverage. Here, I think it's more, let's discuss the claim, and it's quite possible there's coverage. So from a risk management standpoint, the thing would really challenge our clients to do is to think about what is a reasonable standard of care, and what sort of protections should be in place when customers either are coming on premises, or if the insured is visiting with customers. Does management provide the proper PPEs? Is management, say for example, you go into a retailer, are social distancing standards being enforced? And I think these things will be tested and sort of played out in the courts in the future. But while there's what's interesting is these types of scenarios can trigger both coverage under a general liability policy, but also, as we'll talk about in a minute, potentially under D&O policies or under EPL policies. A comment on cost here. I think most folks are expecting a decrease in revenue. Most general liability policies are rated, or rather their premiums are determined at policy inception based on forecasted revenue. So for businesses that are expecting, material reductions in revenue, one strategy you might employ is to speak with your insurance brokers about renegotiating those insurance premiums with carriers today. While the policies do tend to be auditable, and that can get picked up upon policy expiration, we're seeing a push, and we would encourage folks to see what they can do today to get some premium relief. I think there's been some headline news about auto insurers, for example, giving rebates to individuals because the people are working from home, cars are not getting used as much, and so I'd like to think that there's just about everything in insurance is negotiable. So that is definitely a point and a lever that we'd encourage folks to look at. Next slide, please. So workers' compensation, I believe in the poll, some folks said they'd seen workers' compensation claims already. A little bit like property insurance, there's some regulatory risk here that's sort of developing. The questions around, did a frontline worker contract the coronavirus at work, and whether or not that's relevant for what, if they have a workers' comp claim. So the question is, in some states, folks are being allowed to go out on comp because they have coronavirus, whether or not you can trace that to their employment. There are a couple sort of critical, tests there in figuring out if that is in fact a comp claim. Under normal circumstances, just having the disease wouldn't be trigger enough. You'd have to also prove that it came out of the scope of employment and that it was unique to that particular field of work. But it's, again, like general liability, there aren't really inherently any exclusions in the policies. So we're inclined to think that there's, should be coverage sort of regardless of how regulatory decision comes down on whether or not simply having the disease would trigger coverage. Much like general liability, I think it's sort of important to point out that the policy premiums are based on expected payrolls. So again, if you or your portfolio companies find that you've had meaningful reductions in payroll or anticipate reductions in payroll through the end of the year, it is certainly possible to engage insurers in a conversation around potentially returning some premium in advance and basically preempting the audit that you'd have next year, because again, the premium is paid in advance based on future payrolls. If they don't materialize, you're essentially advancing premium to the insurer. A few other nuances there that aren't on the slide. If folks are in the upper middle market, we call it larger employers that might have large deductible insurance programs, particularly for workers' comp. Presumably, if you have a reduction in payroll, you'll have a reduction in claims activity. And what that should mean is, from a balance sheet standpoint, potentially the accruals for retained losses could be impacted. And you could see a reduction there. And then if you have collateral associated with these programs, insurers should be willing to entertain conversations around reductions in collateral based on the lower loss expectancy, again, because the payroll's not there to drive the losses. I think I'm trying to stay on track here on time. If we can go forward to the next slide, please. Okay. D&O insurance. Again, harkening back to what I said a minute ago, I think the decisions managers make right now are so imperative to the types of liability we'll see in the coming months. And D&O it really highlights that. Essentially, the coverage triggers under a D&O policy are sort of a breach of the fiduciary duty to a company's stakeholders. And so we typically think of equity investors, but it can also be lenders, for example. And the policies are inherently pretty broad in terms of what is covered and what can constitute a fiduciary breach under the policy. So it's very easy to hypothesize a lot of different scenarios that would be covered or could potentially trigger coverage under a D&O policy. When we think about management's decision on how to combat the public health aspects of coronavirus, which is a little more challenging because there's bodily injury exclusions under the policies, but some more obvious issues are financial reporting or expectations around revenue following the coronavirus, supply chain management, failing to diversify supply chain risk. There's a host of things like almost like a waterfall effect that could really trigger coverage. Fundamentally, D&O policies, for the most part, don't have pandemic exclusions or other exclusionary language that would just inherently bar coverage. It'll really come down to the specifics of the claim. But the sort of takeaway, I think, is that it's imperative, and this flips back to going forward to the employment practices claims in just a second. We would implore all of our clients to take a very thoughtful approach about every sort of management decision they're making now, because the potential repercussions are pretty wide. So jumping forward, next slide, I guess, to employment practices liability. Essentially, and Chase hit a lot of this, any sort of change in an employee's status could potentially trigger coverage under the policies. Discrimination based on disability status of having coronavirus or looking at an employee's medical history as you're thinking about bringing furloughed employees back could all potentially trigger claims under the EPL policies. Again, they don't have specific exclusionary language for pandemics, but it will rely on the specifics of the claim. And again, it's the actions of management today that will have an impact on those claims. So we'd really encourage folks to talk to their employment counsel before making any big moves, if you will, because there's just a plethora of things that could trigger coverage. With about my last half a minute here, John alluded to it in the beginning of the conversation. Within the insurance industry, no one has a crystal ball. And I think we're all sort of waiting with bated breath as to how this will play out. Could it be moderate catastrophe losses, or could it be the biggest event ever hit the insurance industry? And the reality is we just don't know. But we are finding generally, we are in a hard market. Underwriting standards are getting tighter for D&O insurance and employment practices liability. And we absolutely expect this to drive that hardening market and increased insurance rates going forward, and underwriters' assessment of businesses' ability to manage their risk around coronavirus. And with that, I'll turn it over to John. Thank you.
Okay, thanks, Andy. And if we go to the next slide, I just want to spend a couple of minutes on representations and warranties insurance. There were about 3,000 transactions in the US that were insured with rep and warranty insurance last year. I'm sure some of you who are listening to this webinar have used this product. And I think the reality is we aren't seeing a lot of claims come in yet on these policies. They are, for your new deals, the market is open, they're being written. Deal volume is down by about 75 or 80%, as many of you know, so there are very competitive terms available. What's interesting in the policies now is we are seeing about 2/3, about 70% of the insurance market, the insurers are putting on broad policy-wide COVID-19 exclusions. So that there's enormous concern that they don't want to inadvertently, even though these policies obviously aren't designed for COVID-19 claims, it's hard to figure out where the coverage would lie, certainly historically on them. They don't want to inadvertently pick it up, particularly where they may already have exposure under property policies or work comp or D&O policies. So that's one thing to know. Other insurers are looking more deal by deal and trying to figure out whether they see in their underwriting review that there may be exposure, that business may be adversely impacted, and therefore looking on a deal by deal basis to put exclusions on. And others have really taken the view that the representations aren't really designed to pick that exposure up. I think, they probably will not hold on that position a whole lot longer. So we'll see what happens there. And as mentioned, we, unlike, property in the property policy sphere where we have seen, thousands of claims come in already, we haven't seen a lot under rep and warranty policies. And I think the broad view should be, the way that buyers and sellers and counsel are dealing with these issues is really through the other mechanisms and purchase agreements. It's really going to be more around, looking at, conditions to completion. It's going to be looking at purchase price reductions where you do have impact, on the management financials that are being, management accounts that are being put out because you've got interim financials. There's on the audited financials, if there are any from 2019, there was no impact yet. So not a lot of impacts yet. The market's open, new exclusions coming in all the time, and not a lot of claims that have tested it yet. So I think that's the short view on rep and warranty. And I want to hand back actually to Chase again to finish up on talking about, looking at benefits and regulatory around leave of absence and group benefits. So Chase, back to you, please.
Thanks, John. Yeah, kind of shifting back to benefits and thinking about, I touched a little bit on it before talking about work location when it comes to leaves of absence, but there's just a lot of confusion, a lot of challenge right now for any size employer to figure out what they are required to do and what they want to do in their employer leave policy with respect to leave of absence. And so most HR people and companies are aware of the FFCRA now. This is the law enacted last month that provides emergency paid sick leave and expanded paid FMLA in certain situations. And it's important to sort of distinguish that from regular FMLA and other state leave laws that allow the employee to be away from work versus salary continuation during that time away from work. And so when we say paid sick leave, that means it's not only a reason to be away from work, but it's also a reason to get paid. And similarly, FMLA has in the past only been an unpaid entitlement to leave. Now, if you are taking leave to care for a child whose school or daycare has closed and you're unable to telework or work because of that, then you can get paid through FMLA. And so the paid sick leave is a little bit more expansive than that. And that is for 80 hours or basically 2 weeks to be able to take a leave for, to seek diagnosis for COVID-19. If you already have been diagnosed, if you're subject to a quarantine, you've been told by a healthcare provider to stay home, or to care for somebody close to you who has been diagnosed. Those are sort of the reasons. But the main takeaway here is it's going to take, and for HR people within your organizations, give them some slack because this is really challenging stuff, and but really need to review what your leave policy is, making sure you follow these rules, and then also what do you want to accomplish as a company when you're deciding to be more or flexible with the leave situations. So a couple things to think about there. I mentioned states. We have the FFCRA and FMLA at the federal level, but each state now, and the troublesome states I listed here, New York, New Jersey, California, DC, Massachusetts, Washington, Michigan, most of those are typical regulatory active states. And so they're usually going to have more rules, but in this situation, they have almost all taken extra steps. And so figuring out how those interact based on where the employees in your organization are located, usually that's based on work site or work location. But intertwining, weaving those requirements in with your current leave policy, figuring out which run concurrently. Usually you can run your PTO concurrently with the state or FMLA leave, the emergency paid sick leave, that's the 8 days, 2 weeks entitlement from the FFCRA, that runs on its own. You cannot supplement that. You cannot require an employee to take PTO before taking that. So the good news here though, when we're talking funding, is that there are some tax credits available. The FFCRA, you can get a refundable tax credit on qualifying wages. That would be wages paid for anybody out on a leave for emergency paid sick leave or the expanded FMLA. And then qualifying health plan expenses can also be built into that tax credit. And so if you're continuing benefits for somebody out on one of those leaves, you may be able to also get that money back. The tax credits, importantly, are refundable, which means you can get them whether you owe tax or not, and they're reconciled through the employment tax filing process. So if you're familiar with 941, the IRS form you use to report and pay quarterly employment taxes, that's the same process. And then there's a new IRS form, 7200, in case you pay out more wages than you owe in employment taxes, you can get an expedited request for that back. So that's a federal level to help with the funding. Some states are helping. San Francisco, if you're out on the West Coast there, they also have additional state funding. And then to close it up with our last slide here, if you could advance it really quickly, these are mostly just changes to group health plans. And carriers, if you have a fully insured plan, will handle most of this. But telehealth expansion, coverage for the testing, the screening, the vaccine at zero cost sharing, that's great for employees. They have that confidence that they can go out and have those tests performed. They won't come out of pocket. So we're seeing a discussion about mandating the cost of treatment at a federal level. Some states have already done that. So that's kind of a medical plan level. There are a few other things there that changed with the CARES Act. First of all, you can provide a lot of that without impacting HSA eligibility. That was a big issue. But then this expansion for spending accounts, HSAs, FSAs, HRAs, they can now cover over-the-counter drugs and menstrual products. Previously, you had to be prescribed for that. And then there's this expansion with student loan reimbursements, which I'm a big fan of. I spent too much time in school, and it'd be nice to get a little bit of student loan reimbursement. That's available through the end of the year, up to $5,250. So if you're interested in even more, bringing more value to your employees and you have a population that can benefit from that, that's helpful too. So I know we're at the end of time, so I'll turn it back over to you, John.
Okay, thanks, Chase. And before handing back to Lena, I want to thank everyone who's joined. I hope you found something or several things that were helpful, some practical advice. And thanks to all the panelists for giving that.
Yeah, thank you all so much to all of our participants, and definitely to you all as speakers, Chase, John, Sarah, and Andy. We appreciate your contribution here. I think it's a lot to digest, but I think it's all useful information that a lot of people, even if they don't want to deal with it, have to. So we appreciate that. For all of you who have attended, we will be posting this recording on our YouTube. So look out for that if you need to review any of the information. And again, thank you to our sponsors, Baker Tilly, Ice Miller, and of course, NFP. We have a few webinars coming up. You can see the dates here as well. But feel free to go to opusconnect.com or reach out to us with any questions. Everybody stay safe, and we look forward to seeing you at the next one.
Thanks.
Take care.
Thank you.
Bye-bye.
Bye.